The silent plan to dethrone the US dollar. Why central banks are buying all the gold. What if the silent, steady accumulation of a single asset by the world's central banks is not just a portfolio adjustment, but a signal that the very foundation of our global financial system is being deliberately dismantled? For the past half-century, the world has operated on a shared faith in the US dollar as the ultimate store of value and medium of exchange. This system, which has underwritten global commerce and American prosperity, is now facing its most profound challenge, not from a rival superpower's currency, but from the oldest and most trusted form of money in human history: gold. The fundamental problem is one of trust and mathematics. The United States, as the issuer of the world's reserve currency, has been afforded what is often called an exorbitant privilege: the ability to purchase real goods and services from around the world simply by printing more of its own currency. This privilege, however, was predicated on the assumption of fiscal discipline. That discipline has been absent for decades, culminating in a national debt so colossal that it defies rational comprehension. The math has now become inescapable. The debt is growing far faster than the economy that is supposed to support it. This creates an impossible dilemma for the central bank. To combat the persistent inflation that arises from such massive government spending, the Federal Reserve would traditionally raise interest rates. However, with a national debt exceeding $30 trillion, every percentage point increase in interest rates adds hundreds of billions in borrowing costs to the federal budget. This is a fiscal death spiral. The government cannot afford the very medicine required to cure its inflationary sickness. This predicament, known as fiscal dominance, is the point where the central bank loses its independence and is forced to prioritize the government's solvency over price stability. The catalyst for the current paradigm shift is the global recognition of this American policy trap. Foreign creditors, who for decades have dutifully recycled their trade surpluses into U.S. Treasury bonds, are beginning to question the wisdom of holding appreciating liabilities in a depreciating currency. They are awakening to the reality that their holdings of U.S. debt are a claim on a government that can and will devalue its currency to meet its obligations. This realization has been accelerated by geopolitical tensions, which have demonstrated that dollar-denominated assets can be seized or frozen, transforming them from a safe haven into a potential strategic liability. The response from the world's central banks has been quiet, methodical, and unambiguous. They are buying gold at a pace not seen in over 50 years. This is not a speculative frenzy, it is a strategic repositioning. They are systematically trading paper promises of a single, debt-laden nation for a universally recognized monetary asset that carries no counterparty risk and is no one's liability. This accumulation is the most significant vote of no confidence in the future of the fiat dollar standard. They are not just hedging their bets, they are building the foundation for a new monetary order. We are rapidly approaching a critical tipping point where this slow, behind-the-scenes de-dollarization erupts into a full-blown crisis of confidence. This moment will not be televised in advance. It could be triggered by a number of events: a failed U.S. Treasury auction where there are not enough buyers for the debt on offer, a sudden, uncontrolled spike in long-term interest rates as foreign investors begin to sell their holdings en masse, or a coalition of major trading nations announcing a new system for international settlement that explicitly bypasses the dollar and incorporates gold. This is the moment the dam breaks. When this happens, the illusion of stability will evaporate. The move in the gold market, which has been a leading indicator, will be followed by violent repricing in the currency and bond markets. The dollar's value will not decline gracefully, it will fall precipitously. The bond market, long considered a safe haven, will suffer catastrophic losses as prices plummet and yields soar, to reflect the true risk of holding the debt of a government that can only pay its bills by printing more money. Waiting for this moment to act is waiting until the insurance policy is no longer for sale. The immediate impact on the United States will be a severe stagflationary shock, an economic condition the Federal Reserve stress tests conveniently ignore. A collapsing dollar will lead to a dramatic increase in the cost of all imported goods, unleashing a wave of consumer price inflation unlike anything seen in generations. Simultaneously, the chaos in the bond market will freeze credit and trigger a deep recession. The central bank will be faced with an impossible choice. Either allow a deflationary collapse of the banking and financial system or print money on a scale that dwarfs previous rounds of quantitative easing, risking hyperinflation. The aftermath will usher in a new financial landscape defined by a multipolar currency system. The dollar's dominance will be gone, replaced by a basket of currencies and a renewed role for gold as a neutral reserve asset and a benchmark for value. For Americans, this will mean a painful adjustment. The exorbitant privilege will be lost, leading to a structural decline in the nation's standard of living. The wealth stored in dollar-denominated paper assets like stocks and bonds will be revealed to be illusory, having lost a significant portion of its purchasing power. The great takeaway from this unfolding crisis is the rediscovery of an ancient lesson. No fiat currency has survived indefinitely. The value of a currency is ultimately a reflection of the fiscal discipline and economic productivity of the nation that issues it. By leveraging the dollar's reserve status to live beyond its means for decades, the United States has sown the seeds of its own monetary demise. The future belongs to those who understand that true wealth is not found in paper promises, but in tangible assets that cannot be printed into oblivion. This transition is not merely a forecast, its early stages are already visible. Consider the performance of U.S. markets versus their global counterparts. For years, the narrative of American exceptionalism dominated investment strategy, but that tide is turning. We are now seeing sustained periods where foreign stock markets, particularly in commodity-rich and fiscally sounder nations, are dramatically outperforming the S&P 500. This is the beginning of a great capital reallocation, as global investors, starting with central banks, begin to withdraw from U.S. assets and reinvest in their domestic markets or in hard assets. The rally in silver, often called gold's volatile cousin, provides another crucial piece of this puzzle. While gold's rise is driven by the strategic long-term decisions of central banks, silver's movements are often a more direct reflection of both monetary panic and industrial demand. The fact that silver has decisively broken through previous technical resistance levels, such as the $50 mark, indicates that this is not just an institutional phenomenon. It signals that a broader base of investors is beginning to seek refuge in tangible monetary metals, anticipating a future where they will be indispensable. One of the most telling aspects of the current gold rally is who is not participating. Unlike previous bull markets that culminated in a speculative mania, the retail investor has been largely absent. In fact, data from exchange-traded funds (ETFs) shows that for much of this rally, smaller investors were net sellers of gold and gold-related stocks. They were liquidating their positions into the buying of central banks. This is a classic sign of a stealth bull market, where the smart money accumulates assets before the public is even aware that a fundamental shift is occurring. The retail frenzy is still to come. Similarly, the vast majority of institutional capital, pension funds, endowments, and hedge funds, remains profoundly underallocated to precious metals. The traditional 60-40 portfolio of stocks and bonds is deeply ingrained in the financial advisory world. However, this model is predicated on the assumption that bonds provide a safe hedge against stock market volatility. In a sovereign debt crisis, both stocks and bonds can fall together, as they are both claims on the same faltering system. The dawning realization of this vulnerability will force a historic reallocation, with even a small shift of this institutional capital into gold creating demand that will overwhelm the available supply. The argument that the gold price is rising without a corresponding fall in the dollar or the bond market is a dangerous misinterpretation of market dynamics. Financial markets are not perfectly efficient. Different asset classes react to new information at different speeds. Gold, as the ultimate monetary canary in the coal mine, is the most sensitive to the erosion of long-term trust. It is the first shoe to drop. It is signaling what is going to happen in the currency and bond markets. Those who wait for the dollar and treasuries to collapse before they believe the message from gold will be far too late to protect themselves. Let us project the Federal Reserve's next move. As the economy weakens and the credit markets seize up under the weight of rising real interest rates, the political pressure to do something will become immense. The Fed will be forced to pivot, abandoning its inflation fight to save the financial system and the government itself. This will mean a return to quantitative easing, but on a scale that will make the post-2008 interventions look trivial. They will have to print trillions not just to buy government bonds, but potentially to bail out the entire banking system, which is ill-prepared for the ravages of stagflation. The justification for this future money printing will be a challenge. In previous rounds of QE, the government could point to official inflation metrics being below its 2% target. How can the central bank justify creating trillions of new dollars when official inflation is already running at 4 or 5%, and the real-world experience of consumers is much higher? They will be forced to admit that they are sacrificing the currency to prevent a nominal collapse of the system, a choice that will accelerate the public's flight from the dollar into hard assets. The transition away from the dollar standard is arguably a more momentous event for the global financial system than the United States' abandonment of the gold standard in 1971. That event, the Nixon shock, moved the world from a gold-backed dollar to a pure fiat dollar. This new transition involves the rest of the world voluntarily moving off the fiat dollar standard and returning to gold as the bedrock of their monetary reserves. The rug is being pulled out from under the American economy, which has become structurally dependent on the kindness of its foreign creditors. The decline of the dollar's reserve status will dismantle the pillars of recent American prosperity. For decades, the U.S. has enjoyed artificially low consumer prices because of a strong dollar, artificially low interest rates because of foreign demand for its debt, and artificially high asset prices as global capital sought a home in U.S. markets. Each of these benefits will now reverse. Consumer prices and interest rates will rise structurally, while asset prices will fall in real purchasing power terms. This will be a painful and prolonged period of national economic adjustment. It's crucial to understand the changing psychology of the market. Previous peaks in gold and silver were often characterized by extreme speculative fervor from the general public. This time is different. The primary buyers are the most conservative financial entities in the world, central banks. They are not chasing momentum, they are methodically de-risking their balance sheets. The fact that this powerful, foundational buying is occurring without the participation of the speculative masses suggests that the potential upside for precious metals is far greater and more sustainable than in previous cycles. The long-term performance of gold versus mainstream financial assets tells a story that Wall Street has long ignored. If you measure the Dow Jones Industrial Average not in dollars, but in ounces of gold, the index has been in a massive bear market for over 2 decades. An investor who simply held a gold coin in a shoebox since the turn of the century has seen their wealth grow more significantly and safely than one who held a basket of America's top companies, even after accounting for dividends. This stark reality is slowly forcing a reckoning within the investment management industry. This secular outperformance is why we are beginning to see cracks in the institutional wall of resistance to gold. Prominent analysts at major investment banks, who for decades dismissed gold as a pet rock, are now advising clients to allocate a portion of their bond holdings to the monetary metal. They are belatedly recognizing that in an era of negative real interest rates and escalating sovereign risk, traditional government bonds no longer fulfill their role as a safe asset. This intellectual shift is just beginning, but it will open the floodgates for trillions of dollars of institutional money to seek a home in the tiny precious metals sector. The future financial system will not be a return to the classical gold standard of the 19th century. Instead, we are likely to see the emergence of a hybrid system. Gold will serve as a neutral, politically agnostic settlement asset between central banks, providing a bedrock of trust that is currently lacking. Nations will increasingly back their own currencies, at least partially, with physical gold reserves to enhance their credibility on the world stage. This creates a more balanced, multipolar system where no single nation can wield the same level of financial power that the United States has for the past 75 years. The implications for international relations are profound. The ability to run massive trade deficits without consequence will end for the United States. Trade will need to become more balanced. Furthermore, the effectiveness of financial sanctions as a tool of foreign policy will be greatly diminished in a world where countries can transact outside the dollar-based system. This shift represents a fundamental rebalancing of global economic and political power, moving away from a unipolar American-centric model towards one with multiple centers of influence. The coming crisis will also force a painful but necessary reckoning within the United States. The nation will have to confront the reality of its unsustainable fiscal path. The social contract, built on promises of entitlement programs that are mathematically impossible to fund, will have to be renegotiated. This will be a period of immense political and social turmoil, as the consequences of decades of short-sighted policymaking come home to roost. The economic pain will be severe, but it may also be the catalyst for a return to a more sustainable economic model based on production and savings rather than debt and consumption. Investors must rethink the very nature of risk. For generations, the biggest risk was seen as being out of the stock market. In the coming paradigm, the biggest risk will be holding only paper assets denominated in a currency that is being systematically devalued. The definition of a safe asset must be reevaluated. Is it a government bond that is guaranteed to lose purchasing power every year, or is it a tangible asset with a 5,000-year history as a store of value? The answer is becoming increasingly obvious. The rally we are witnessing in precious metals is not about price. It is about panic. It is a rational, calculated panic by the world's most informed financial players, the central banks, who see the endgame for the current fiat monetary system. They understand that in a world drowning in debt, the only viable life raft is an asset that is not simultaneously someone else's liability. Their actions are a clear and present warning that a profound transformation of the global monetary order is no longer a distant possibility, but an unfolding reality. The acceleration phase of this bear market in U.S. assets will likely be driven by domestic investors. While foreign investors are leading the initial exodus, the real stampede for the exits will begin when American citizens and institutions lose faith in their own currency and government solvency. When the average American starts to view the dollar not as a store of value, but as a depreciating liability to be spent as quickly as possible on real goods and assets, that is when the inflationary crisis will enter its final, most destructive phase. The ultimate consequence of this unfolding drama will be the complete repricing of all assets. The valuation of stocks, bonds, and real estate will be questioned as the monetary unit in which they are measured loses its stability. We will see a great divergence between the price of assets and their true value. An asset's price may go up in nominal dollar terms, but its value, measured in gold or its ability to purchase real goods, may be plummeting. This is the great challenge investors will face, discerning the difference between nominal illusion and real wealth. We are in the early innings of a historic wealth transfer. Wealth will move from those who hold paper claims on an over-indebted system to those who hold real, tangible assets outside of that system. It will flow from nations that have consumed beyond their means to those that have produced and saved. The rules of the financial game that have been in place for our entire lifetimes are being rewritten. Understanding this fundamental shift is the single most important factor for preserving and growing wealth in the turbulent decade ahead. This is not fear-mongering, it is financial realism. Every major currency crisis in history has followed the same pattern: a slow, gradual erosion of confidence, followed by a sudden, catastrophic collapse. The signs of that slow erosion are all around us, from the unprecedented levels of government debt to the overt actions of central banks seeking an alternative to the dollar. The gold price is not the cause of this crisis. It is merely the messenger, reflecting the growing realization that the emperor of the fiat currency system has no clothes. The crisis is not coming, it is already here.